That's another issue. It's not a financial issue. It's accounting, right? Tax planning, all right? So let's assume, well, there's nothing we do for tax, but in finance, we can make a decision whether you use debt or not, all right? So that means you can see fixed costs determine the operating leverage, and interest payment, which is the amount of debt you borrow, determine your financial leverage. Okay, right? Now, one thing is that here, high cyclical stock, they usually have a high beta. That means when you move up and down with the economic cycle, then you have a high beta. Remember I told you the equation, the beta is the correlation coefficient with the security and market times the kind of security standard deviation divided by the market standard deviation. All right? But you have to distinguish between cyclicity and variabilities or volatilities. All right? Now this example, this Excel file, I just use some random number to show the two different concepts. So now I have this is assumed is the market. I just use some random generator generate the return. At the same time, I also generate some stock return for stock number 1 and stock number 2. All right? Now if you calculate the standard deviation of 1 and 2, well, this is, I just use the standard deviation of a sample equation of or function in Excel. I calculate, well, this is the standard deviation for stock number 2, and this is the standard deviation of stock number 1. So you can see stock number 2 has a higher standard deviation or higher volatility than stock number 2. So if you ask me which one is more volatile, I would say stock number 2. Agree, right? But stock number 2 does not necessarily mean it has a higher market risk. All right? So if you ask me which one has a higher total risk, I say, okay, stock number 2 has a higher total risk because its standard deviation is greater than stock 1. All right? But the market risk of 2 is not necessarily higher than stock number 1. Right? So let's calculate the beta, all right, or the correlation coefficient. So here I just use the correlation coefficient function in Excel. I calculate the coefficient of market and stock 1, and I calculate the coefficient of market and stock 2. So we can see stock 2 is almost independent. The standard deviation, the correlation coefficient is 0.01. But for stock number 1 and the market, highly correlated. It's 0.91. Right? So let's assume the risk-free rate is 0, make it easy. I calculate the beta. All right? So I calculate the beta. This is 0.45. This is 0.01. So if you look at the market risk, actually stock 1 has a higher market risk than stock 2. Okay? So usually it's that high risk, high return. So if you have higher standard deviation, you should have a higher required return. But it's not always true. Right? Because standard deviation measures total risk. But the return is based on market risk. So from this example, stock 2 has higher total risk, but lower market risk. Because stock 2, most of the risks, they can be diversified away. Okay? So this is a very important concept. Make sure you understand the difference between total risk and market risk. Market risks are measured by beta. Total risk measured by standard deviation. Okay, right? So if you look at the diagram, I can just, this is stock number 1 and market, this is stock number 2 and the market. So you can see most of the time, when the market is up, stock 1 is up. When the market is down, stock 1 is down. But for stock 2, sometimes they have, you can see they actually move in opposite direction. The market is up, stock 2 is down. So that's why they're kind of independent. Sometimes together, sometimes they move in opposite direction. Okay, all right? So any question about volatility and cyclicity? Yeah?
Please repeat the point that you were saying about the market risk is determined by beta, and what was the total risk determined by?
Total risk is measured by standard deviation. Market risk, now total risk at absolute measure is a percentage, 5%, 10% is an absolute measure. But market risk is a relative measure. 1.2, 0.8, all right? And total risk is equal to market risk plus diversifiable risk or unit risk. All right. So in this example, stock 2, it has stock 2. Right. Let me make sure I remember correctly. Stock 2 has a higher total risk. It has a higher standard deviation, but its market risk actually is low because most of the risk of stock 2 can be diversified away. All right. So market will not give you any return if you bear diversifiable risk, because why you do that? There's no point of doing it. All right. So let's say I hire you to clean my house, but when you go to my house and clean everything, even my laundry, I will not pay you extra. All right, because you do something that I do not ask you to do. Okay. Right. Now, before I look at this, let me just look at another PDF file. Okay, this is the adjusted beta for a financial leverage. Last week, I said in one of the slides, if your company is similar to the industry, you can use the industry beta. But if the industry debt to equity ratio is significantly different from your debt to equity ratio, you cannot, right? You have to adjust the beta for different financial leverage. All right. So in this example here, so you need this for your question 1 of assignment 1. All right. And now this question, well, you can also apply it to the same company. That is, well, if a company changes its financial leverage, what will be its cost of equity? What will be its equity beta? What will be its WACC? All right, the same logic, same idea. But let's come back to this example. So let's say here, you want to estimate a private company. So I just call it, this is company 1. All right, so I just call it U. All right, so this is U company. All right, so you want to data this private company. Since it's a private company, you don't have any stock price information. So you cannot run regression to estimate its beta. All right, okay, so you have no information about this. Okay, but well, one approach very commonly used in finance is look for comparable. That is, if you can identify another company that is very, very, very similar to yours, and that company has the data available, then you can use that company's data and apply to your company, but you need to make necessary adjustment. Right? Okay, sometimes. So let's say you assume you find a company, I just use O and U, right? Let's you stick with O and U. O and U. All right? So let's say you identify we identify O company which has an equity beta of 1.48. So that means it is a public company. So it has stock prices available. You can run the regression against the market and estimate the beta. All right. So let's say you find the beta is 1.48. Right. And O has a debt to equity ratio of 2:3. Okay. So it is a public company. So that information is available. So you can identify, okay, its debt to equity ratio is 2:3. But now your private company, you want to have a debt to equity ratio of 4:3. Instead of 2:3, you have 4:3. All right? And being a private company, you also assume your cost of borrowing is 8.6%, which is 60 basis points higher than O. All right? So the cost of debt of the company is 0.086. All right, 8.6%. Now, the O company is a public company. It has a lower cost of debt. Now, 100 basis point is 1%. Right? This is the term we use in financial market to avoid confusion. Because let's say, if you say the interest rate is 2%, let's say, make it easy. Interest rate is 10%, and you increase interest rate 10%. So what does that mean? Is it 10 to 11 or 10 to 20?
10 to 11.
Well,
11.
it can be either one of them. So that's a confusion. All right? So in the market, say if you want to say I increase interest rate from 10 to 11, so I increase interest rate by 100 basis point. So everybody know is 10 to 11. If it is 10 to 20%, you increase your interest rate by 1,000 basis point. Right? So that's why if you the Federal Reserve, they said they announced the interest rate decision, they decrease by 25 basis point or increase by 25 basis point. That's 0.25%. Okay? So 86 basis point is 0.006. Right? Oh, sorry, 60 basis point, 0.006. So that means the cost of debt of O is 8%. Right? So this is the information we have. And they assume the market risk premium is 6%, the risk-free rate is 5%, corporate tax rate is 40%. So that's everyone is the same, that's tax rate is 40%. Right? So the question now is we want to estimate the WACC of this company. So to calculate the WACC, okay, we have the debt to equity ratio, we have the cost of debt, but we don't have the cost of equity. To find the cost of equity, we need the equity beta. So if we have the equity beta, we have everything needed to calculate WACC, right? So how do we estimate the equity beta? Well, using the information from O, all right? So the first thing we do is, okay, let's calculate the debt beta of O. So if O has an 8% cost of debt, its debt beta is 0.5. This is just cap M. Risk-free rate 5%, market risk premium is 6%. All right? So using the security market line equation, we find the debt beta is 0.5. So after we get this, so we found, well, your debt beta is 0.5. Now the first step is to unlever your equity beta. Using the equation I just gave you, cost of this equal to equity beta using all this information, we find the asset beta. We know equity beta is 1.48. We know the debt beta is 0.5. We know the debt to equity ratio is 2/3. We know the tax rate is 30%. Right? So using this equation or the MMM proposition number 2, you find that your asset beta is 1.2. So this measures the business risk of O. Right? Agree? So now new is a compatible to O. So that means it is the same business risk. We assume they also have the same production technology, the same fixed cost, variable cost. So that's why it's compatible, right? You try to identify a company that's exactly the same as new. All right. So that means new should also have. So this asset beta should also apply to new as well. So new and O, they are identical except financial risk. So we apply this equation one more time. So this time, you use the same equation one more time. But this time, you have this 1.2. And then you also have your new debt to equity ratios for the 3. You have the tax rate of 0.4, right? Assume there's no change in tax rate, everything the same. So the only thing you need is what is the debt beta of new. Now, since we know the cost of debt of new, using the capital asset pricing model equation again, we figure out that the debt beta of new is 0.6. All right, so now we also have this. So we have everything on the right-hand side of the equation, and you can find the equity beta. So that's two steps here. The first step, unlever the beta, that is take away the financing effect, find asset beta. And then we leverage the beta. That means we impose a new debt to equity ratio to the asset beta. All right? So now we find the new equity beta is 1.68. Now it should be larger than 1.48 because with higher debt to equity ratio, you have higher financial risk. All right? So I strongly encourage you during exam, don't panic. When you calculate something, just spend 1 or 2 seconds and check that number makes sense or not. All right? So if you get, let's say you do the calculation and find 1.28, you know you must make a careless mistake in your calculation, maybe a fat finger. All right? So now, in exam, of course, you get point deducted, but if you carry on the question using the wrong number, I will ask the TA not to deduct any carry forward error. But still, it may cost you some time in exam because if you use a different number 1.28 and then continue the calculation, the next step or the next 3 steps you may get some nonsense number. And then you get confused because, hey, why does the number get negative? It should be positive. All right? So just take you a lot of time and well try to find out what the error was. Okay? I had that experience many, many years ago. I still remember it's a cost accounting exam, all right? So I copied the answer from this page to the next page and do the calculation. I just missed the sign, all right? So I just spent a lot of time to figure out, wait, what's the problem? Why I get the funny answer at the end, all right? So spend a few seconds, just ask this number makes sense or not. Yeah, greater than 1.48, yeah, it makes sense. Then continue, all right? So once you have the equity beta is 1.68, apply the capital asset pricing model equation, you get the cost of equity is 15.8%. So now you have everything to calculate your new company cost of capital, the WACC, weighted average cost of capital. Because the company has a debt to equity ratio of 4/3, so that means debt to asset is 4/7. All right? So students sometimes has difficulty convert this number, but it's easy because that debt to equity is 4/3. So that means just very simple. Assume debt equal to 4 and equity equal to 3, right? Because this is the ratio given. So if you want V, which is asset value, 7. So now what is B over V? What is S over V? Right? Alright? Once you have the ratio, forget about how much it is. Doesn't matter $1 million, 5 million. Well, just assume the easiest number, 4/3. Assume debt is $4, equity is $3, so what is total value? 7. You have all the ratio. Okay? Always think simple. Always use a simple example. Right? Okay. Yeah, the same thing, something like, yeah, a student always make that kind of mistake. So if you can, let's say, from 47 to 2,047,000, how many numbers do you have there is, right? So sometimes it's the largest number minus the smallest one, and don't forget to plus 1. But why? Well, because it's easy. So just think about 2 to 4. How many numbers there? 4 minus 2 plus 1, which is 3, because 2, 3, 4. right? Use simple example, you can prove the formula very often. That's mathematical induction. Okay, all right? Always think simple. So any question about using the equation to estimate the new WACC for the firm? So you need this for your assignment 1, question number 1. Okay? Now next we look at the operating leverage and the financial leverage. This is assignment 1, question number 2. Alright, assignment 1, question number 2. So I told you operating leverage is related to the portion of fixed cost used in your production and the portion of variable cost you use in your production. Operating leverage, that is fixed cost, magnifies the effect of solidity on beta. Right? It's not just whether you move up and down, but also your production technology. Now, there's a measure of operating leverage. We call it the DOL, degree of operating leverage. The higher the degree, the higher the risk, higher the sensitivities. So the formula actually is percentage change in EBIT divided by percentage change in sales or volume. All right? So if you have a DOL of, let's say, 5, so that means 1% increase in sales, you have 5% increase in EBIT. 1% decrease in sales, you have 5% decrease in EBIT. Alright, so that's the sensitivities of this. Okay, so if you look at this 2 diagram, and the red one is the company use variable cost and only small amount of fixed cost. And the green one is the company use automation, but they still need to hire someone to operate the machine, so they still have some variable costs. All right. Now, if you look at the change in the volume and change in EBIT, well, you can see the one with fixed costs have a higher sensitivity. That means a small change in volume, it has a largest impact on the EBIT compared to company using relatively small amount of fixed costs. All right, okay. Now the formula, actually, if you look at, I have the equation right here. Actually, EBIT is just equal to the quantity times the contribution margin per unit minus fixed cost. So this is accounting. Cost accounting, so everybody should know how to determine your EBIT, earning before interest and tax. All right. So if you look at this equation, EBIT is equal to Q times P minus VC. This is the price per unit, variable cost per unit minus the total fixed cost. Now this is a linear line. This is your Y, and this is your X variable, and this is your B coefficient, and this is your constant. But your constant is just negative in this case. Your constant is just negative F. Alright? So you can draw this on a diagram because it is a straight line. Alright? So the red is, in this example, the red is a company that use no fixed cost. So when your sales is 0, your EBIT is 0 because you don't need to pay the fixed cost, and there's no variable cost as well. All right. Now for the dark green line, the company use some fixed cost, so that's why its intercept, the A, is negative, minus fixed cost. All right. Now the slope of the line is this. All right. The contribution margin per unit. So if you look at, let's say, with fixed cost, the one in green. So if you use fixed cost, then your variable cost per unit will be smaller, right? Because you use a lot of fixed cost, you only need to hire a few laborers to run the machine. So therefore, the variable cost per unit will be small. Now, of course, we assume the price will be the same because we want to compare apple with apple, orange with orange. So the price is the same, that means the contribution margin will be larger. So that explains why it has a steeper slope, because this is the slope of the line. Okay, all right? Now, when the two have different slope, they should have, unless they're parallel, otherwise they should have an intersection, right? Okay. Now, this point, the textbook call it break-even point, but I will use the word in different point. That means at this sales level, the two production technology will be indifferent because they get the same EBIT. Now the textbook, they call it break-even point is, the argument is, if I use one production technology and move to the second production technology, at what sales level I will be break-even, right? So that's why they call it break-even point. So the break-even point is not the sales, now in cost accounting, this is the break-even point, right? When the EBIT is 0, that's what they mean by break-even point in accounting. All right, but in here, the break-even point is, can you compare two technology? All right, in accounting, this is just one technology, the break-even point of this technology, the break-even point of this technology. Okay, but another better word actually you can use the indifferent point or in different quantity. All right. To solve this in different quantity is extremely easy. So what you need to do is you calculate your EBIT, which is the Q times price minus variable cost 1 minus fixed cost 1. So this is the first production technology. And then the second production technology is the Q times price minus variable cost 2 minus fixed cost 2. So you want to find the Q so that the two are equal. So that's the break-even quantity or the indifferent quantities. Okay? So you need it in your assignment too. I want you to find the indifferent point. Alright? Now, the degree of operating leverage. So it's not in the slide, but let's just look at here. This is the degree of operating leverage. So the percentage change in EBIT over percentage sales change in sales. So I just replay everything. I do not go step by step. Go home and take a look at it. Now, if you simplify everything, this is the measure of degree operating leverage, which is, this one is the contribution margin over EBIT. So this is not per unit. This total contribution margin divided by the EBIT. That's the degree of operating leverage. Okay? Now next we look at financial leverage. So I told you debt financing is a fixed cost of financing. So if you borrow money, you have to pay interest no matter you have a positive EBIT or you have a negative EBIT. You still have to pay interest. All right? So we want to calculate the degree of financial leverage. So the degree of financial leverage. So now if you look at it here, I drew the diagram somewhere here, is related to this. That's between EBIT and earning per share. Right? Operating leverage is with Q, which is about the revenue, and between these two and EBIT. Right? And now it's between EBIT and earning per share. Alright? So the same thing, we can have the break-even point or indifferent point. So now this diagram, your x-axis is EBIT and the y-axis is earning per share. All right, okay. So if you look at the formula to calculate earning per share, we know it is your EBIT minus interest payment minus tax, so that's why I multiply by 1 minus t, and divided by number of share outstanding. All right. So if you look at this equation, earnings per share is equal to EBIT minus interest times 1 minus tax divided by number of share outstanding. If you rewrite the equation, you have EBIT 1 minus T divided by number of share outstanding minus interest 1 minus T divided by number of share outstanding. Alright? So again, this is a straight line. So this is your y, this is your x variable, this is the coefficient. 1 minus T divided by number of share outstanding is your coefficient, minus this is your constant, fixed interest payment. Alright? Now the number of share outstanding will change if you change your capital structure. Alright, because the company is not going to expand or trim down, right? So that means we use the same asset. We compare apple with apple, orange with orange. So that means we use the same asset in production, but just change the capital structure. So if you use more debt, so that means you use less equity, right? You borrow money and use the money to buy back some of the equity. So that means when you buy back the equity, the number of share outstanding will be less. Right? So that's why if you have a different capital structure, the slope will be different because the number of share outstanding, 1 minus T is the same for both for the company, right? It's the same tax rate. But now when you use more debt, the number of share outstanding will be less. So that means this B will be larger because the number of share outstanding is in the denominator. When the denominator is getting smaller, the slope is getting bigger. So that's the reason why when a company uses debt, the dot green one, you have a deeper slope. If the company does not use debt, the red line, then you have a smaller slope. Okay? And the intercept is just negative because you have interest payment times 1 minus T divided by number of share outstanding. The same logic to calculate it in different point is this time you calculate this is your EBIT minus T 1 minus this divided by this number 1, this is number 1. You want to make it equal to your EBIT minus interest payment 2 because you have a different level of debt, then your interest payment will be more or less, depends on you borrow more or borrow less. Right? And then minus interest payment, minus tax, and then divided by number of share outstanding 2. So your job is to determine what EBIT will make the two the same. Right? Okay? Now, so this is what we call the degree of financial leverage. So the degree of financial leverage is just based on our definition, the percentage change in earnings per share to the percentage change in EBIT. So if your degree of financial leverage is, let's say, 5, so that means 1% change in EBIT, you have 5% change in earnings per share. All right? So the larger of this degree of financial leverage, the higher the sensitivity. That means you have higher risk. All right? And again, we can simplify the equation and do everything, but since the interest rate is fixed, blah, 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 and what we did has this. All right? So the degree of financial leverage is just earnings before interest and tax divided by earnings before tax. Okay? Now, we have another measure. I don't think I put it in the slide. I did not put it in the slide. Yeah, I did not put it in the slide. But this is just a common sense because, well, this is the percentage change in earnings per share to the percentage change in your quantity. That is 1% change in quantity or sales, what effect will be on the earning per share. So it's just the product of the two, right? If this is 5, that's 25. That means 1% change in sales will have 5% change in EBIT. So 5% change in EBIT will have 25% change in earning per share. I assume both are 5, right? DOL and DFL both are 5. So the degree of total leverage is just the product of the two. So if you look at the formula, we can do all the step. It's just the contribution margin, total contribution margin of the company divided by your earning before tax. Okay? So question number 2 is all about degree of financial leverage, degree of operating leverage, degree of total leverage, and the indifferent point or break-even calculation. Alright? So this week the quiz is also related to this calculation and assignment 1, question number 2. Alright, so now after today's class, after this, you should be able to do question 1 and 2 of assignment 1. Now, so this is what I just mentioned. So this is the adjustment. Financial leverage always increase equity beta related to the asset beta, right? Okay. Now, we want to talk about the remaining topic in chapter 13 before we move on to capital structure. So in chapter 13, they discuss a few more topics. One of it is, well, the firm versus the project. So actually we discussed a little bit. That is, when we use the discount rate to find a project, NPV, it should be based on the risk of the project, not the risk of the company. So I mentioned that last week. If the project risk is significantly different from an existing asset, don't use the firm current cost of capital to discount it. All right? So that's the idea is this. That is, if you just use one, because let's say this is a firm equity beta, and you use this to discount all projects, then you will have all kinds of type 1 and type 2 errors. All right? So for those projects, they're actually good projects because according to this risk, the return should be this. And this project gives you a higher return than it should be. So they are good projects. But you use this one hurdle rate to evaluate this project. You reject it. And you say, okay, this project has a lower return than my hurdle rate. But in fact, no. Right? According to this risk, the right required return should be this one, not this one. All right? Now, on the other end, you incorrect accepted negative NPV project. All right? So this project, according to this risk, the required return should be this. But it only gives you a return at this level. It should be a bad project. You should reject it. But if you use your firm one rate to discount it or evaluate it, you accept it because it's higher. So you make this type 1, type 2 error. Okay? All right, so this is the concept we talked about last week. Now, in the textbook, they also talk about flotation cost. Flotation cost is a cost you use to raise capital. So let's say, for example, you have to pay the investment banker. So we will talk about that in chapter 20 and 21. All right? Now, I will leave the flotation cost to chapter 18. Because in chapter 18, when we do the capital budgeting, the company, they raise capital, they need to pay flotation cost. It is part of the project cash flow. So I will wait until chapter 18 to talk about flotation costs. All right? But at the end of the chapter, there's a few little good exercise, and actually I assigned some of them. So just take a look at those exercises to have a concept to calculate the weighted average of flotation cost. That's it. Okay? But the actual calculation of flotation cost, I will leave it until chapter 18. Right? Now the last topic they talk about is liquidity. They said, well, the liquidity, the company, if the firm is very liquid, then shareholder require a lower return. That is, liquidity and the cost of capital, they have inverse relation. If the firm is extremely illiquid, then you will require higher return. Now, if the firm is extremely liquid, you require lower return. Now, how do we define liquidity? What is liquidity? Now, liquidity means you can sell a large quantity or you can buy a large quantity of the stock at or very close to the market price. That is, the market is very deep. All right? Now, in liquid asset is, okay, the market price, let's say for example, okay, let's say this is a bid-ask spread. So this is $11. I just use dollar, make it easy. This is 10, this is 8 and 9, and this is, let's say, 15 and 20. Okay, so at 10, someone want to buy 100 shares. So this is a number. So let's say they want to buy 100, 1,000. This one want to buy 9,000. This one want to buy 8,000. So that means at the price of 8, someone want to buy 8,000. At the price of 9, someone want to buy 9,000. At the price of 10, someone want to buy 1,000. All right? But on the other side is the ask. That is, they want to sell how much they want. If they can sell for it, so let's say this is 500. All right? Make it smaller. Let's say this is only 100 share. And this is 2,000, and this is, let's say, 5,000. Now think about it. If you want to buy, let's say I want to buy at market price. I just listed the stock. I just place a market order. I don't care the price. I just need it. If I want to buy 5,000, how much you have to pay? You pay a lot because you do not get a 11. 11 is the market price right now at this point. But there's only 100 share outstanding or available. All right? So if you buy 5,000, 100 you pay $11, 2,000 you have to pay $15, and the remaining 2,900 you pay 20. So this stock is illiquid because the market depth, the market is not deep enough. All right. On this side, it may be deep enough because you have a large quantity. That means if you sell, but even you sell 5,000, at least you get $9, very close to the market price. All right. So if a stock is very liquid, that means you buy or sell a large quantity. The money you get or the money you pay should be close to the market price per share. All right. That means you don't need to accept a very high price to buy or very low price to buy if you want to trade a large quantity. So if you look at Royal Bank, CIBC, those big companies, well, it's very liquid. Even I go there to buy 1,000 share, 2,000 share, 5,000 share, I can almost get this market price at that time, right? But if you want to buy a little tiny Toronto, let's say technology company, if you want to buy 5,000 share, well, probably you will not get all at the market price. You may have to pay a much higher price because the depth is not deep enough. The depth of the market actually is very, very low. All right. So if you ask yourself, if I trade this company, it's very illiquid, probably I require high return. That's the liquidity premium. I require premium for this kind of risk. That is, I buy the stock, but if I need money, I want to sell it, I have no buyer, right? I have to drop my price by 20%, 40%, 50% in order to get rid of it. Then I require higher return, right? So that's the argument of liquidity and cost of capital. Now, there's a few other things that determine the liquidity of a stock, right? So one thing is what they call average selection. Now, average selection is based on the argument of information asymmetry. This is a bid-ask spread. So let's say it's between 10 and 11. Now, in Toronto, in North America, the system is order-driven. But in the center of the trading floor, there's a group of people who call it market maker. They are the person that provide liquidity. That means they have the obligation to buy certain share at this price, at 10 and 11. They are the market maker. They are appointed by the Toronto Stock Exchange, TSX, so they're major banks, all right? Okay, they're major banks and some of the big financial institutions. So they keep an inventory of the stock. So let's say this is ABC stock company, all right? So they will keep an inventory of ABC. If someone want to buy, they sell it to those person. If someone want to sell, they buy it from them, all right? And they make money from the bid-ask spread because if they buy 10 shares, they pay. If they buy at this point, okay, someone sell, all right? So if they buy, they only pay $10. They sell, they get 11, right? That's how the market maker make money. So this is similar to foreign exchange. You go to US and you buy US dollar. When you come back from the ship, you sell the US dollar back to the bank. You get less, right? That's the spread, the bid-ask spread, all right? Now they argue if you have information asymmetry. That is, I'm a market maker, and in this market, I have no extra information. Assume some of you in this room, you know this stock, for some reason you know some private information. You know this stock, the price will increase to, let's say, $20 in the next minute. So what will you do today? Now, or now, not today, now. You will buy it, right? You will buy from me. So when you buy, you only pay $11. So I'm selling my inventory to you at $11. But the value should be 20 because the new is there but just arrived 1 minute later. So I'm losing money to you, right? Because you have some private information. Okay? So as a market maker, and I will lose money if I trade with some informed trader. Now, if I trade with ordinary investor, I make money from you because of the bid-ask spread. So if the market is not that efficient, someone has advanced information, so I will keep losing money. So in order to be profitable, the only thing I can do is widen the bid-ask spread. I widen the bid-ask spread because I lose money from trading with you, and I try to get the money back from ordinary people by widening the bid-ask spread. Yeah.
But you don't really lose money though, because
Yes, you do.
no, because if the price increases to $20 in the next minute, you're still selling at the $10 price because you have an inventory of it that you bought at that.
No,
price.
I sell at 11. I buy at 10.
Sorry, you're buying it at 10, but
Buy
you're
at 10.
yeah, but you're still selling it to that informed trader.
No,
at
but in the
$11.
next second, because because you know the information, you will buy a lot from me. So suddenly you buy 1 million shares from me. So I sell all the inventory to you. All right? All right? In the next second, when the price suddenly the news release, so the price go to 20, but the bid will also increase as well because both will increase. At that time, it will be 18 to 20. At that time, the new bid and ask will be 18 and 20. All right? So at that time, when I buy back my inventory, so I have to pay $18 to buy it. I just sell it to you at 11 minutes ago.
But
right?
in that new case, you would have the inventory that would otherwise be valued at $10.
The inventory what?
So in that $20 scenario, if you didn't have to sell it to the informed trader, you'd still have the original bid value. So I assume you have an inventory of the stock, right?
I have the inventory, right?
Right. So you would have kept that inventory if the informed trader hadn't bought it. So you're assuming that that's future potential profit that you're
Well,
losing.
I still have to keep an inventory of the company because I'm a market maker. I need to provide liquidity. So I have to stand ready to buy and sell.
Right, but in the end, you're only losing potential profit. You're not actually
No. Potential profit actually is a law.
correct. But in the end, it's just you're not really losing money. It's just potential.
No. The same wrong concept. Don't forget that scale mistake. All right. Many years ago, there's a famous investor. He argued during the financial crisis, AIG, which is one of the largest insurance company, they own a lot of bonds, right? And those bonds, they are good big company. And the AIG stock price decreased a lot. And he publicly said, okay, don't worry about that. They are big good company. You will get the face value back eventually. That's not no bankruptcy. So the drop in the AIG price is unrealistic. It's ridiculous. But that's not true. That's not true. Even a paper loss is a loss. Even you get the money back, so what? because this is about opportunity cost of capital.
Mhm.
All right. If I have the money now, I buy the same $1,000 at face value. I only need to pay $200 today. All right.
Right.
So that's the opportunity cost of capital concept. So even some of the practitioners, they're in the market for so many years, but they are weak in concept, in theory. So that's compared with university education and college education. We emphasize on theory. So if you know the theory, you almost know everything. That's you build a framework right here. Practical consideration is, yes, sometimes you know how to do it, but you don't understand the logic, right? So in this case, if I trade with you, and the fair value is 20, and I sell it to the 11, I actually have a loss. Even though I buy it, maybe I buy this inventory in the past for $2. So what? It's a sum comp, right? Compare my gain and loss compared to the market value today, not how much you paid many years ago.
Makes
So
sense.
some investor always compare, okay, I buy my house 20 years ago at, let's say, $500,000. And now I sell $1 million, I make that money, I'm having a positive. But if you consider cost of capital, you may have a loss. All right, that's the same concept. Okay, so I'm sorry, maybe I just have a 10 minutes break. So please, make it 4:10. Please come back at 4:10.